and this is the Coins, Cashflow, and Conversations podcast. I am your host, Dakota Grady, sponsored by Upstate Eastern Solutions. If you need help with accounting and taxes or personal finances, contact me today at dakotagrady.com and get you a free resource about how to save money in your business with tax strategies. Again, the website is dakotagrady.com. Yeah, welcome to the podcast. So y'all can hear my voice. Like I lost my voice like Saturday. I'm under the weather, and I've been sick since like Thursday. But my voice went out basically on Saturday. I spoke on Juneteenth, my personal finances. I was a vendor at an event in Greenville, South Carolina. Then I got home and this happened to me. So I committed to doing this podcast consistently for the next 90 days, like I said, from this month to that verse, June, July, August. I'm doing the podcast Monday through Friday, whether I feel good or not. I'm here to add value to you in your life. So today, talking about the FICO score. What is the FICO score? What does it mean for you? And why is it important? All right, so the Fair Isaac company basically created this way of doing the basically how to measure credit worthiness, right? If you're willing to pay your how willing are you paid how willing are you to pay your bills back basically? You borrow money from a lender, do you pay them back on time or late? So I did research on that and basically there was a system set up in place where people's credit worthiness was based on their age, their ethnicity, and their marital status. So the Fair Isaac Company, or FICO, came up with a system that uses five criteria now to help lenders basically say, all right, is this person credit worthy of paying their money back? So do they have ability and willingness to repay the loan that we have sent to the person? So here we go. We're going to talk about the FICO score. It consists of these five things: payment history, pay amounts owed, length of credit history, new credit, and credit mix. All right, so let's break it down. So 35% of your FICO score is your payment history, 30% is your amounts owed, 15% is length of credit history, 10% is new credit, and 10% is credit mix. All right, so payment history, first one, most of your credit is based on history of paying back the loan. So if you haven't been good with paying back your credit, then you'll probably have a low score. So FICO scores go from 300 up to 850, right? And I joke a lot. I joke about that because I'm like, people be like, "Be your credit, my credit score like 10,000." Not really, but I just like to clown on that because I'm not a credit person. But you can only get up to 850, which is basically a perfect credit score. So if you have paid back your loans over a period of time consistently and you have a good payment history, you probably have a good credit score then, right? Because your score is high because you paid back the money over time. Your payment history has been good. So when I had my credit card, I was with, I think, American Express or Capital one of the companies, and I was with them for like 8 years, like a long time. Before I said I'm gonna use cash opposed to using credit. So when I did that, the guy was like, when I was going to close my account, the guy was like, "Are you sure?" I'm like, "Yes, I'm sure. I'm confident I'm gonna close my account. Yes, I am sure." So it's like, all right. He said, all right, so I closed my account after having it for 8 years. Now it's hard because I had that credit history built up of borrowing money on my credit card and paying it back. Because I was an auditor, I traveled around the country, auditing with collection agencies. So I used my credit card for my travel, hotel, meals, and other things when it came to me traveling for my employer, and I got reimbursed. When I got reimbursed, I just paid that money back on my credit card. So I paid it off every month, basically. So I had to get credit history, payment history, by paying it back over time. The second one is amounts owed. Now, if you owe a lot on your credit card, you don't pay it off at the end of the month, you will get a penalty or you get repaid interest because you have basically borrowed someone else's money, OPM, even though maybe on a revolving credit card, for example, you still have an amount owed. So the cost of borrowing money is what? Interest. So you pay interest on the amount that you have outstanding on your credit card. So you have, if you owe a lot on your credit card and you want to get more money from a loan for someone else, the bank gonna go against you because you already owe someone money. So the next creditor will say, well, you owe company A, I'm going to be company B, so you probably going to get a higher interest rate because company A is in line before company B is. If you were not able to pay your loan, you go bankrupt, for example, then they want to get that money. If you say sell it up, company A get paid first because company A was there first. So again, it probably go against you if you have a lot owed on your credit. Link the credit history. Again, I have my that's 15%. I had mine for again about 8 years, just consistently paying it back because I like owe nobody nothing, like nothing. Like I use my credit card for my travel, got money, paid it back. That's what it was. So link the history, credit history. Again, I've had that car. I had the car for 8 years, so I had to get length of time of borrowing money and paying it back over time. So I built up my credit score. I think my credit score like a 741 last time I checked it before I stopped using debt. So it was pretty good because I had borrowed money over time to get payment history, paying it back. I didn't owe a lot. I paid it off. And my length of history was good because I was with them, a credit card, for so many years. And then the new credit is amounts 10%. Say if I want to get a new credit card, then I'll be able to get one because my credit score is good. To get history of paying money back. I didn't owe a lot of money or any money. So I had to get a score. And my credit mix was probably like saying you have different types of credit. You may have a credit card, you may have a student loan, you may have a loan with a bank. You have a different mix of credit, right? Not just one particular loan type. So that could probably hurt you as well. If you have too many loan types, I mean, everything is like I guess like a balance, right? So why am I talking about credit scores? Credit scores, we use them in America, around the world, for credit worthiness, right? But credit score doesn't tell you how much someone has in their savings account, how much they have in investments. It doesn't tell you those things, right? It don't tell you how much someone has paid back over time, how often they pay back, or haven't paid it back. That's simple. So all it says is that you like and love to borrow money. That's for y'all. So if you are banking on building your credit, you're banking on building your payment history, owing money for a length of time, having new credit, and having a credit mix. That's basically what it is. All debt, 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 debt. 5 levels of debt. What are they saying? So you build your credit score up to 850. You have a balance on that account. Oh, I pay it off. But if you don't pay it off, you pay interest on that amount. And then you take an advance from that credit card, for example, you'll pay more, a higher interest rate, right? Okay, you're taking somebody else's money, getting an advance. Like you're drawing money out of a bank account, taking that money out, and you're using it for whatever, and you pay back interest on that money. So why am I talking about this? Because it's important because we're so bombarded with borrow money borrow money, be a credit, be a credit, be a credit. When you do that, you make someone else rich and you stay broke. By the way, copy the book at dakotagrady.com. So I recommend using cash instead of using credit because when you use cash, you don't pay interest, which is cost to borrow money, and you stay out of debt. Having no debt is like the best way to live. So I want to challenge you today to use cash for 90 days. Use it for 90 days. See what happens. If you want to go back into debt, fine. But take the challenge to use cash for 90 days and see what if your life won't change. FICO score is only keeping you broke. Again, get a copy of the book at dakotagrady.com. Keeping you broke and keeping somebody else rich. That's why people are so bombarded because companies want to keep you broke, keeping you giving you their money or giving them your money, and you struggling, worried, stressed out. So I challenge you, if you can, use cash for everything, y'all. I know I'm weird, but I want to be weird, and I want you to be weird too. So I hope this episode, I know my voice wasn't good, but I want to come on here and give you value, talk about the credit score. It's boring, but we use it for things, but I recommend using cash. Be different, be weird, and don't be like everybody else. Be broke and struggling, because 78% of people struggling financially. I don't want it to be you. Use cash rules, cash Christmas credit all day long. Because you borrow money, you pay it back with what? Cash. So cash rules all day long. Again, this is the Coins, Cashflow, and Conversations podcast. I know I sound terrible, but I want to add value to y'all. Be committed to the process of bringing you value every single day for 90 days. This is the Coins, Cashflow, Conversations podcast. Subscribe to it. Share, like, comment. Again, I apologize for my voice, but hey, I wanted to add value to y'all. Stay committed to the process. Go to the website, dakotagrady.com, to get a copy of my free resource to help you save money in business with tax strategies at dakotagrady.com. Click on the tab that says tax sections. Click on there and get the resource for you. Again, this is the Coins, Cashflow, and Conversations podcast, y'all. Thanks for joining us. Oh, yeah, it's not terrible.